So we're absolutely delighted to have James Fletcher here with us today. James Fletcher is the founder and chief investment officer of Ethos Investment Management, a focused emerging markets equity fund, which launched in January 2022 with over $100 million in committed capital from some renowned anchor clients. Previously, he was director and senior portfolio manager of the emerging markets small and mid-cap equity strategy at APG Asset Management, where he managed a $1 billion asset under management fund, investing with a long-term active portfolio approach to invest in high-quality businesses with strong ESG integration. He previously worked as senior portfolio manager of emerging market equities at Kane Anderson Rudnick, where his emerging markets fund was Morningstar 5 rated. Prior to that, he was senior analyst at Westwood Global Investments, a top-performing emerging markets boutique based in Boston. He's also the founder of the global nonprofit Young Investor Society, which has risen to become the largest investment program for high school students around the world, reaching over 1,200 schools in 24 countries. He graduated with a bachelor's in international finance from Brigham Young University. Thank you for joining us today, James.
Itai, it's an honor. You put together such a great program, so many esteemed guests. So I'm just delighted and honored that you would invite me and grateful to speak today.
Yeah, terrific. It's good to have you. And why don't we just begin a little bit by you talking about launching Ethos and sort of the process of doing that and also the investment philosophy of Ethos.
Yeah, absolutely. So we launched Ethos Investment Management in January of this year, as you mentioned in the kind intro. Thank you for that. Really ever since my early days in the industry, starting out at a boutique, seeing the success of building a small boutique from the ground up and controlling the culture and building the team and really feeling aligned with clients. And I'm entrepreneurial by nature. So ever since those early days, for me in the industry, it's always been the dream to hang my own shingle and launch my own fund. And I'm just so grateful that we were able to launch Ethos with some fantastic seed clients. How we invest is, similar to how you mentioned in the intro, a focus on quality businesses with a long-term concentrated approach. We say that we take a private equity style to the public equity market. So deep, extensive due diligence, management checks, channel checks, and then ESG integration and management analysis and company culture analysis, which we can talk about later, which we bring to our investment process. And then engage with the company. We take a partnership approach as we invest. So get to know the family, help them improve on allocations, on governance, on disclosures, and take a more consultative approach to investing, which has been very helpful to us in terms of alpha generation in small, inefficient, family-run businesses in emerging markets, China, India, Latin America. So yeah, launching Ethos right now. We're excited about the opportunity, and this has been really the goal from the beginning of my early life. My grandpa was a scientist from NASA. He was actually head of NASA for 2 terms, but his passion was investing. So one of my earliest memories is, him putting me on his lap and talking to me about the markets and reading the Wall Street Journal. And, that sort of instilled in this love for me of the markets. And when I was a teenager, I read Buffett. And really, that just turned my world upside down, investing with a common sense approach in high quality businesses. And so ever since that day, as many of you in your class, Itai, and many of your listeners feel, I think, this kinship, but I've just been hooked ever since. And it's just the passion of my life is to find great businesses and invest in them for the long run.
Yeah, absolutely. Maybe speak a little bit about why you're more attracted to, let's say, the more modern Buffett philosophy of finding great businesses with moats, rather than, let's say, the more younger Buffett or Benjamin Graham philosophy of looking for nets and cigar butts.
Yeah, absolutely. And I think, Buffett made that transition with a prodding and influence from Charlie Munger And Charlie Munger is also one of my investment heroes as well. And so, yeah, I mean, that it's a good question. That comparison between net nets and cigar butts and sort of deep value into quality, great businesses and long-term compounders, which is where we focus today. In general, it's just as a portfolio manager, it's frankly easier to find a great business and let it run for 10 to 20 to 30 years than have to constantly reinvent and refine, cheap stocks, and they can re-rate, and then you divest those, and then you find a new set of cheap stocks, and there's a good amount of having to predict, having to do research on new businesses. When, on the other hand, if you can find a Google or a Starbucks or an Apple, which you have high confidence will continue to compound, and that moat, that economic advantage, will sustain over the next 10, 20 years, that makes your job easier. So part of it is, I'd say, just laziness or practicality of, finding a couple great, exceptional businesses increases your odds of success. Now, I am focused on emerging markets, and my whole career I've been focused on emerging markets. So emerging markets have the added risks and concerns of bad governance, fraud, political risks, geopolitical risks, currency risks, macro cycles. And so for me to take a long-term approach, I need to find exceptional businesses that have pricing power, that I have strong confidence in both the business model and the management team that's running this business, because of the inherent risks that I'm dealing with in countries like, China, India, Eastern Europe, and Latin America. So it's proved to be a very effective way of both managing risks and also finding long-term compounders.
Yeah, I think that makes a lot of sense. And speaking a little bit more about ESG, one, what sort of attracted you to a more ESG focus in the first place? And also, I mean, I would imagine that larger companies might even have their own division that, helps the company focus on ESG, whereas smaller companies might not have the budget for that. So is there issues finding ESG information that's accurate for some of these smaller companies in emerging markets?
Yeah, that's a great question. So just a step back, I mean, I am, as we talked about from my background, I am focused on quality and focused on long-term returns, and that's proved to be, a very successful formula for our clients and for long-term returns. When I joined APG, which is Netherlands' largest pension fund to run $1 billion for them, they believed in the process, they believed in my track record, but they also added an ESG overlay and a lot of ESG data points. They were Netherlands is one of the leaders in ESG investing. When I'd say when I first started out, I thought, a lot of that disclosure and ESG data would be more of a distraction to my core investment process. But what we did is, our team in Asia, we built ESG scorecards. We took all of that ESG data on employment, diversity, employee turnover, governance, board structure. We took all of that data, carbon footprint, and we assimilated it into how would a long-term fundamental investor think about those factors in terms of materiality. We created ESG scorecards, and we engaged with companies to help them improve where they were ranking low and where they were ranking high. And this ESG assessment was way more in depth than your typical MSCI ESG report or Sustainalytics ESG report. And what we found, I'd say, was a pleasant surprise, is that this ESG analysis was another tool in the toolkit for, long-term fundamental investors to analyze risks and also to engage with companies. So to your point, a lot of emerging market, small cap or mid cap companies are family run. they're inefficient, great businesses, but are disclosed less just due to the fact that they're smaller, they're not mega caps, they don't have a whole division to disclose, ESG factors. And so we were able to come in and help them and move the needle through that process. So let me give you an example. So Nice Information Services is a company in Korea. So Nice Information Services, Nice Info, they are, you can think of them as the Experian, the TransUnion, the Equifax of Korea. So the largest consumer credit ratings business in Korea. They have 72% market share within Consumer Credit Bureau. Their credit scoring system is the credit score that all Koreans need to apply for, car loans and home loans. And they have an oligopoly, high returns on capital, great business, right? Proven in developed markets. We went and met with them in 2017. We were, according to them, the first institutional investor to meet with the CFO. At the time, they were a $350 million company, didn't disclose in English, had no broker coverage, and as a result, trading at 12 times PE ratio compared to global peers trading at 30 times PE ratio. So, and what we found was an exceptional business, very high returns on capital, wide moat, oligopolistic, and a long runway for growth of monetizing that core credit data. We, our due diligence takes 2 to 3 months minimum. So we did our due diligence process, channel checks, management calls. And after the end of that due diligence, we found a company that was extremely undervalued, but also showed a lot of signs of, positive engagement, interested in our ideas. At the time, the board was family controlled. They only paid a 15% dividend payout ratio. They didn't disclose in English. So there was some low-hanging fruit there in terms of engagement. And we basically took a meaningful stake in the business. So we ended up buying 5% of the shares outstanding. And through that process, we engaged with the company. So we built a strong relationship. They started publishing in English. Actually, what happened in Nice Info's case is the chairman passed away and the son of the family took over, and he was very open to our engagement targets. And they put in independent board members. They started attending investor conferences. They raised their dividend payout ratio. And as you can imagine, what happened as a result is the stock re-rated dramatically. So the stock, tripled since we bought it. The stock is re-rated to 25 times price earnings ratio. And, so we're able to benefit as shareholders along with the family and the owners of the business because of those inefficiencies that we were able to help unlock because of that engagement process. So we actually view ESG as another toolkit of engagement. It's not, the focus is on quality businesses, but if we can find them cheap and undiscovered like Nice Info, and we still find many opportunities like that across emerging markets.
Yeah, absolutely. That makes a lot of sense. And that was an example of maybe a successful case study of investment in the past. Maybe let's talk about one as well that, failed and didn't go so well.
Yeah, no, exactly. If we're right 60% of the time in our business, that's a great success ratio. So, the key is on the mistakes to mitigate that mistake process. Let me give you an example. In India, a company that we invested in called Parag Milk. Parag is the largest branded cheese manufacturer in India. They have a very strong, series of brands. One of them is Go Cheese, which is basically packaged string cheese, like string cheese that we have in the States. And they're the largest commercial supplier of cheese to, brands like Pizza Hut and Taco Bell throughout India. We met with the company. Dairy tends to be, pretty pretty good business. Packaged dairy was low in India. They had just undergone a transition from the family to professional management team. So they had put in professionally managed CEO, professionally managed CFO, and all things looked to be good. And similar to Nice Info, the stock was trading at 13 times earnings and was cheap relative to global peers. Unfortunately, Parag turned out to be a tough investment. The dairy market is cyclical, as we know by nature. So raw materials, raw milk prices go up and down. And so you will go through cycles of the industry, which is expected. I'd say what happened on Parag's case was a couple of governance issues. So the family had pledged shares to the bank, and this limited their ability. There was overhang that they may have to sell the shares. And then as they went through this difficult time with rising raw milk prices, the CEO left. His name was Venkat. He left, the CFO left. And what we subsequently came to hear is that the family just had a very tough time of basically handing it over to the professional management team. And even though they were bringing in new management, it was really the family running it. It was, a my way or the highway type culture. And, company culture is extremely important. And that transition from family run to professionally run is a key, issue across any family run business. So one of the key lessons that we learned from Parag and from others similar to Parag Milk is governance is key. So in emerging markets, company culture, company governance, how they treat employees, how they incentivize employees is key. And employee turnover is one of the key metrics that we look for. So when we invest in especially smaller cap companies, the governance and the management have to be pristine. And we've seen many errors of, business looks good, but let me give you another example. So there was a company in Korea that we invested in called Hansum. Hansum is basically the IKEA of Korea. And Hansum is had a long track record of growth and high returns and high margins. But we started to do our typical engagement process and push the company, engage with them. And basically what we heard back from the CEO was anger at us for even suggesting that that we knew how to suggest items for his business. The CFO actually called us later and said, just so you know, like, we don't question the CEO. He makes all the decisions. We just started through that channel check process, starting to hear some negative things about the company culture, how the business was run. So we ended up divesting all of our shares. And subsequently, Hansum, they had a sexual harassment lawsuit. They didn't fire the employee. They got a lot of negative publicity from it. And then they, 6 months later after that, they bought a very expensive office building in downtown Seoul, and the stock was down, 50% after all of that negative news. So we learned a lot through that engagement process. That's why we build relationships with businesses and we engage with management teams and boards, because you learn a lot about the culture in the end. And that's why I called it ethos investment management. In the end, the question of what is the ethos of the company, what is the culture of the business, that is the key question to answer. If you can find a company culture like Starbucks early on, that is one of the highest predictors of long-term earnings growth and sustainable growth and returns for a business. And so we look for those exceptional, top 5 percentile of businesses that employees want to work for, college graduates want to join. They have this, mission, and they have this company culture and this product that is palpable and in demand. And if we can find those businesses, there's a high likelihood that those are the long-term compounders.
Yeah, absolutely. I think that makes a lot of sense. And switching a little bit to speaking about, starting a fund, how do you know when is the right time to start a fund, and how do you raise that initial capital?
Yeah, I mean, that's a good question. My advice would be not to start too early. I have 17 years of, track record working at some of the most, successful emerging market funds. And then as a portfolio manager, I have now 8 years of top decile, peer performance and strong alpha generation. And even then, fundraising and raising a fund is a challenge. So I think you want to build the pedigree, you want to build that track record. I think that's very important for institutional clients. I started out at Westwood Global Investments in Boston, which we went from $200 million to $12 billion when I was there. Performance was strong, and we had a concentrated approach to high quality businesses in emerging markets. But I'd say one of the key factors to success was those early clients. They had a long-term investment horizon. They believed in us and our process. And because we had that competitive advantage of long-term capital, we were able to invest in a differentiated way and deliver great results. So when I launched Ethos, that was critical, is that I had long-term clients. My seed capital came from 10 family offices from Asia, Hong Kong, Japan, and from the United States, institutional and family offices that really believed in me, knew my track record. Many of them, had sort of built that relationship over many years. And, that seed capital, I think, is very important to have committed clients. And then I'd say the second thing is, for me, like, why now is the ESG. And so the focus in ESG, and there's so much publicity on ESG right now, both positive and negative. And there's so much, greenwashing, and I would say really, really sort of misrepresented ESG strategies. I think that's part of why we built Ethos from the ground up, from a long-term returns perspective. How should we think about ESG and materiality? So you just using an MSCI report or a Sustainalytics report and buying, the highest rated companies. I think many clients don't know that the Sustainalytics reports are primarily measuring, policy disclosures, very superficial measurements, and they're running sort of ratings on tens of thousands of companies, but they don't really understand the governance, the culture, the employee turnover. And that's where, we would argue to do ESG analysis properly requires a tremendous amount of work and knowledge on the company, on the owners, on the local country and their, individual, relative standards and how they rank relative to a Korean company, what incentivizes Korean employees and diversity. And so just to do a global standard and primarily rate companies on percentage of policies disclosed, I think is completely misrepresenting ESG. And I think that's why you're seeing a lot of the pushback on ESG of, the BlackRock whistleblower case that came out recently and similar events. I think that's one of the motivations for me is why launch now, is because all of the allocators are in the world are going to say, okay, I know I need, low carbon footprint. I know I need ESG. I know my clients are asking for it, but how do I implement it? And do I have to accept lower returns to have a more sustainable portfolio? And what we can say credibly, because it's my track record and coming from APG, which is the leader in ESG investing, is we can offer you a product that's low carbon footprint, that's sustainable, but through our ESG engagement, we've actually been able to add to alpha, add to returns, and reduce long-term risk. And we're doing it through a whole robust analysis approach, rather than sort of using an MSCI rating and calling it good, which is what most funds are doing right now. So I think there's a lot of misrepresenting and greenwashing going on in the industry, and that's partially why we launched Ethos, to correct that. And we have a credible track record of alpha generation through that.
Yeah, absolutely. I think that makes a lot of sense. And we noticed that your fund has low exposure to utilities and real estate and materials. Is that because of an ESG perspective? Is that because it's some of those things are outside of the circle of competence? Maybe speak about that a little bit.
Yeah, so I would say the low exposure to materials, energy, which obviously energy has hurt us on a relative basis year to date, utilities, property and real estate. I'd say that's coming from primarily our focus on quality. We like businesses that have moats, that have pricing power, and that are proven to be high returns on investment businesses. And so that naturally leads you to the sectors where moats are found, which is consumer, healthcare, IT, internet, platform, network effect businesses. That being said, we're not willing to pay any price. So it's quality at a reasonable price with long-term structural earnings growth. And that's kept us away from maybe some of the story stocks and just, some of the thematics that promise growth, but we're skeptical can ever deliver sort of cash flows to justify the price. So it's very focused on, free cash flow generation of quality long-term compounders. Like we said, we're long-term, low turnover, buy and hold investors. So for me, I need businesses that have long-term structural growth and pricing power. So that does not find itself easily in commodities that are, cyclical by nature and commoditative by nature, energy or property market. So, we have lower exposure in markets like this where energy prices are rising, but that's fine, because our companies are delivering, double-digit 20% earnings, cash flow growth at reasonable prices. And over the long run, like Benjamin Graham said, in the short term, the market's a voting machine, but in the long term, it's a weighing machine. And what is the market weighing? It's weighing those long-term fundamentals. So if our companies can grow solid double digits, protected by moats with high returns on invested capital, and we're getting them at currently over a 5% free cash flow yield on average, that long-term compounding, we have high conviction will carry the day in the long run. So that's how we invest. And I'd say in general terms, for your listeners that may not be aware, emerging markets are trading at significant discounts to developed markets. So EM has lagged over the past 5 years to developed markets, for sure. But a big portion of why it's lagged is because it's just derated. It's delivered earnings growth. And especially in where we focus, the structural growth sectors have delivered solid earnings growth, but you've seen derating and you've seen massive re-rating in like US tech companies. And this year, EM has outperformed developed markets in the sell down, which I think many investors are surprised given the hostilities in Eastern Europe and the worries around the world. Investors are surprised that EM has been a bit of a safe haven, but part of it is that EM was trading at significant discounts, 40 to 60% valuation discounts, depending on the valuation metric that you're looking at. So, but over the long run, so 20-year returns in EM is nearly identical. It's even slightly higher than US markets. So they've all delivered 9.5% annualized US dollar compounded returns over a 20-year period. So over the long run, these markets are very similar, but over the short run, you're getting a nice entry point into EM right now. So we actually find great businesses trading at 40-50% discounts to what they would trade in to their developed market counterparts, and offering very strong long-term earnings growth. So yeah, we're excited about the opportunity in EM right now.
Yeah, absolutely. That makes a lot of sense. And can you speak a little bit more about your process for sourcing ideas and whether that includes using either quantitative or keyword screeners?
Yeah, so the sourcing process is, I'd say, similar to most funds out there. We have quantitative screens. We meet with hundreds of companies a year. We attend investor conferences, and all of that is to build a pipeline of companies that we call our focus list. And these are about 300 companies that we've done the work, we've vetted, and these are high quality businesses, which we would say are in the top 5% within their sector globally in terms of quality, returns, management, and long-term structural growth. Where I'd say we maybe differ is that we take a very targeted approach to business models and to moats and to quality. So we're not just investing behind sectors, or we're not thematic investors. What we are business model investors. So we've developed and concentrated on 40 to 50 business models that are proven across the world to be high wide moat businesses, are proven. And so let me just give you some examples. So businesses that fit in this proven compounder bucket would be online classifieds, especially chemicals and food and flavoring like a Givaudan, testing and inspection services like an SGS or Intertech, consumer branded businesses like an Apple, which are very strong branded businesses, network effect, moats in the internet, on e-commerce. So these are proven business models in both emerging markets and developed markets. They tend to be winner take all or oligopolistic type businesses. And we follow these business models across the world. So yeah, like Nice Info we talked about before, we were looking for credit ratings agencies because we know these are fantastic businesses from their global counterparts. And the good thing about emerging markets is that oftentimes EM is 5 to 10 years behind developed markets. So you can look to developed markets, look at the playbook, look at what business models rise to the top and compound, and then go find those business models in emerging markets. So online classifieds, job portals is a proven business across the world. We own the largest job portal in Korea. We own the largest high-end job portal in China. We've owned the largest job portal in India, in Russia, and in Taiwan. So we find exceptional business models that we think are, like you said, in our circle of competence, and maybe not as understood by local investors in Taiwan or India. And we take a global view, find those businesses, and then conduct our sort of deep, extensive background checks on the management, on the business. So we're pairing our global understanding of business models with our on-the-ground knowledge in emerging markets and families and governance. And that's proved to be a good formula. I mean, other examples are testing and inspection services, like an SGS, Intertech. These are wide moat businesses because the brand of qualifying a product and giving it sort of your quality standard makes it so it's a very oligopolistic business. The brand and the IP matter a lot, and that's why SGS and Intertech and BV have proved to be very fantastic investments over 20 years. We own testing and inspection services in China, center testing and GRG testing. We own the largest consumer electronics testing business in the world. So it's a company in Taiwan called Sporton. And these are asset light businesses, but have very high moats and benefit from the rise in their vertical categories. So that's maybe a differentiated way in where we find businesses, where we source ideas, and how we build portfolios.
Yeah, absolutely. And just speaking maybe a bit more broadly now, what are your views right now on sort of where energy is going and how long it's going to take to sort of phase into renewable energy? And will, fossil fuels in any sort of shape still play a role, let's say, a few decades from now?
Yeah. So like I said, I mean, energy is actually no. We have no energy exposure in our portfolio, sort of oil exposure. We tend to play energy through either companies that supply to the energy sector, or just owning the best business. I'd rather own the best business in Brazil, which will benefit from high oil prices, but I own a business which is a high quality long-term compounder, but the economy will be going through an oil surge. I'd rather own that type of business than buy, the largest oil company in Brazil or the largest oil company in a country, because they're very cyclical and have proven to be, tough investments for the long run. Energy long term, I think we've seen a transformational shift in solar and renewable energy over the past 3 years. I don't think there's any going back, and I think oil prices above $100 a barrel are only going to accelerate that. But as you're aware, a lot of our industry has been looking for a while in terms of non-subsidized neutrality on solar prices relative to other electricity prices. And according to, there's various calculations, but according to a lot of calculations last year, solar hit with the, lowering of price of panels, the economies of scale coming from China, solar hit neutrality in electricity prices last year. I think this will signify a meaningful inflection point for renewable energy, for demand of solar. EVs, I think, are a game changer. I think, I drive a Tesla, and I mean, it's a game changer once you have it, to not have to stop at gas stations, and it's so you just see that acceleration of adopting EVs. I think that will continue and accelerate, certainly, with high oil prices. But like I said, we're not commodity predictors. I'm the last person in the world to try and predict where oil prices are going to be 6 months from now. But what we do try and have a good eye on is structural industries emerging and where their long-term trends are. And we're certainly very, very excited about renewable energy and that transition playing out over the next 5 to 10 years.
Yeah, absolutely. And then just talking again more generally, but about the EV sector, we see Tesla sort of, an early mover into the sector, and right now maybe with the highest market share, I believe, in the EV sector in the US. Do you think they sort of have a permanent sort of moat, or do you think that sort of more legacy players will be able to steal market share away from them in the longer term?
Yeah, so as you know, I focus on emerging markets professionally. So my view on Tesla is just a personal opinion, which has not been, vetted and done our extensive due diligence process, which we do professionally. So, I really just have a personal opinion on Tesla more than a professional opinion. I think they're fantastic cars. I think, in general terms, and maybe bringing it back to emerging markets, companies in China like NIO, which is the China equivalent of Tesla. And, in general terms, we like businesses that are naturally oligopolistic and naturally have very high returns on capital. The auto industry has not proven to be an industry that has those dynamics. It's proven to be an industry that's competitive, that's cyclical, that's low margin. And even Elon Musk would be the first to, he talks about all the time how competitive, this auto industry is that he's competing in. So, it's for me as a investor of business models, I would much prefer a supplier of the auto market or a supplier of the technology that goes into EVs than trying to predict which auto brand will be the leader 5 or 10 or 15 years from now, because that tends to be more competitive than going upstream and talking about the supplier of the technology or the supplier of the components. So that tends to be where we focus, and it tends to be where we have more exposure. So we don't currently own NIO in the portfolio, or we don't own automakers, but we own platforms or suppliers behind what I think is no doubt a long-term secular trend of rise in EVs. So yeah, I mean, that's how I answer that question.
Yeah, absolutely. That makes a lot of sense. And we're seeing some sort of activist approaches with some of the oil majors right now, where they're trying to push them more to pivot to renewables. Do you think any of them will sort of be successfully able to make that pivot, or do you think that the culture is just too ingrained of the traditional sort of fossil fuel mentality?
Yeah, that's a great question. Especially, for us coming from a, engagement approach on the ESG side, we're always asked about, some of the successful engagements in the oil industry, in the US oil companies or global oil companies. In general terms, we've had the most success of finding high quality businesses that are inefficient on their disclosures or on their governance, family run, maybe more immature businesses in terms of institutional practices, but are well-meaning. And then underlying this is like a nice info, like a very high quality, wide moat business. That's where we found the greatest success of engagement, because there you can move the needle and the stock can re-rate dramatically and be priced, similar to global peers. It's harder to go to an oil company and to convince them to completely revamp their business model and invest in renewables, or like in, a materials company like coal. There's a lot of pressure to take a coal company and then convince them to invest in, renewable energy and a more clean source of energy. That's tough. I mean, it's tough to go to a company and convince them to completely overhaul everything and kill their existing business and invest in renewables. So as a investor, trying to get, predictable, high success rate investments, that's tougher. But I think the message behind that is a good one, which is, when you can engage with a company and move the needle, that can have dramatic returns. And so, the other part of ESG is a lot of investors are just excluding everything, right? Okay, we're ESG investors, so we're only going to invest in, low carbon footprint and, A-rated MSCI ESG leaders. And, that is what it is. But what we find is, on the ESG side, a lot of the biggest change and a lot of the biggest, positive returns come from that engagement and moving the needle. And so when you can find a great business that is immature on ESG and help them improve, like Nice Info, which we talked about, that you can make a difference both on the ESG side and also on the return side. So, we think it's too simplistic of an approach just to screen out 80% of the universe and just say, here's what we're investing in. The engagement process can actually move the needle, but we draw the line on quality. Like, the business has to be high quality, and the management team has to be very good. It's just well-meaning that they weren't sort of at best standards, and we can help them arrive at those best standards.
Yeah, I think that makes a lot of sense. And you've had some interns for Ethos. What qualities and backgrounds are you looking for in the interns that you hire?
Yeah, so given this is a college level podcast, I would love applications. You can, see on our website, ethosinvest.com, and you can find contact information. and apply for the internship. Currently, I have 3 interns, one from Columbia University, one from Duke University, and one from Brigham Young University. And I believe there's a lot of strength in the next generation. So we're constantly going to have interns and hire from those interns. Why do I believe in interns? Part of it is because my experience with Young Investor Society. So as you talked about in the intro, I founded Young Investor Society, which is becoming the CFA Institute for high school age kids. We teach modules on financial literacy, on budgeting, but all the way to advanced investing, discounted cash flows. We do a stock pitch competition annually at the high school level where 10,000 kids participate. It's the largest of its kind. And what I've seen is that even high school age kids are so smart, so capable, and so able to do great work. And so I really believe in training young. I was fortunate enough to, right out of undergrad with very little experience and knowing nothing, basically, being hired as an intern as a junior during my undergrad year, and just learning on the job the art and the craft of investing. And so I think there's a lot of power in internships, hiring young, and so we're very interested in internships, and I believe in training and mentoring. And I guess I would just give a shout out on here, and some of your past guests have been my personal mentors. This industry is more of an apprenticeship than anything else. It's learned oftentimes by experience, certainly, but also one-on-one training. And I have been just so blessed in my career from great mentors, great investors that have taken a liking to me and put me under their wing and traded ideas, and I aspire and hope to do the same. So I always try and give back and mentor and take interns, and I'm happy to reach out on LinkedIn to anyone that would like to, and talk about career advice or talk about stocks, because I personally have been so blessed by great mentors that have come before me.
Yeah, excellent. That's terrific. And for a concluding question, what have been the most influential events of your investing career?
Yeah, I mean, good question. I think certainly the large sell downs are big events. Like global financial crisis of 2008, Asian financial crisis in late 2000 or early 2000s, late 99s. 2015 taper tantrum, COVID this year. Those sell downs are big memories. I remember in 2008, as a young analyst, being worried about my job, being worried about the clients, being worried about markets. And I remember looking to my portfolio managers and just seeing them calm in the storm, and focused on the business and focused on fundamentals and anchored to, their businesses, and being shocked at how they were able to be, calm and on top of things through that volatility. And I think that is an important trait for investment success, is being able to keep your head when all about you are losing theirs, but being greedy when others are fearful, and fearful when others are greedy. A specific example is we invested in a Korean video game company. This was one of my first recommendations. This was the largest MMO RPG, which is online, like a World of Warcraft type business in Asia. And we were one of the largest institutional investors early on in the name. The business case, the investment case on this Korean company was, the cash flows are very sustainable. They have legacy games that pay monthly payments every month, and that's very sticky, not going anywhere, very cash generative. And that hits in the future will come, but it's very hit and miss what games will be successful. But they are able to attract the best developer team in Asia. We invested, and then they launched a very anticipated game. They launched it, and the game turned out to be a flop, complete flop. Stock was down. Revisited the investment case, and company was cash generative. They still had the best development team in Asia, and it was hit or miss, and they had a miss, and so the investment case was intact. So we continued to invest. A year later, they put out the next game. It turned out to be a massive flop. Stock was down significantly again. I was under a lot of pressure as an analyst. How do you keep your conviction when your job's on the line and when clients are upset? But the investment case, they still had their legacy cash generative games. They still had the best developer team in Asia. And it was hit or miss, but they still had likelihood of hits in the future. So we doubled down. We added to our position, and next year they put out a little sleeper game that turned out to be the largest game in China, a massive hit, and a hit in Korea, and the stock was up 5x after that. That was an early event, which you never forget. So you never forget that pain, that stress of, feeling under pressure from, your bosses and also clients, but then having the conviction to stick to the fundamentals if the investment case remains intact, and to see that pay off. So that, that's one of the memorable experiences in my career, which you take those lessons with you for the next stocks.
Excellent. Well, thank you so much. This has been a tremendous session.
Thanks,
Really
Itai.
appreciate you taking the time out of your busy schedule to speak with us today.
No, thank you for all you do, and and for your listeners, feel free to reach out. So always happy to chat.
Excellent. Have a great day. Thank you.
Thanks, Itai.